What is anchoring bias? Have you ever made a decision based on the first piece of information you received? That's what we call anchoring bias. It's a common mental shortcut where people relying too much on the initial information, or anchor, when making choices. This can lead to errors in judgment, especially when new information comes into play. In the world of personal finance and investing, anchoring bias can have a big impact on how we assess risk and make investment decisions. For instance, imagine an investor who buys a stock at a certain price. If that price drops, they might still think it's worth that initial amount, even if the market conditions have changed. This can lead to overvaluing or undervaluing an asset. Banks and credit unions need to be aware of this bias because it affects how clients make financial choices. When clients are choosing investment products or evaluating loan terms, they might cling to their first impressions. Financial advisors can help by encouraging clients to be aware of anchoring bias. This awareness can lead to more objective decision-making. Providing clients with a variety of perspectives and data points can also help. Instead of focusing on just one piece of information, having multiple references can lead to better evaluations. Using decision-making tools can further reduce reliance on arbitrary anchors. It's also important to educate clients about how cognitive biases, like anchoring bias, affect their financial behavior. This understanding can help them better evaluate risks and returns. Anchoring bias doesn't just affect individual investors, it can also influence market behavior. Analysts might anchor their earnings forecasts to previous prices or industry averages. This can impact stock price movements and market efficiency. Even corporate managers may adjust their actions based on how they think investors will react due to anchoring bias. For example, they might consider stock splits based on past price points that investors remember. If anchoring bias goes unrecognized, it can lead to poor financial decisions. Banks and credit unions can play a key role in helping clients question their initial anchors. By encouraging a broader range of information and balanced investment decisions, they can support better financial outcomes. So, the next time you make a financial decision, take a moment to reflect on whether you are anchoring your judgment to that first piece of information. Being aware of this bias can lead to smarter choices and a more successful investment strategy.